Rohr here with an early global view on Wednesday, July 8th, 2015. It's currently 7:10 a.m. U.S. Central Time, and we're coming to you just a bit later than usual because once again we wanted to allow as much of the international influence, especially out of Greece, but now out of Asia as well, get priced into the markets. And we're very glad we did because this morning, just recently, there was a letter from the Greek government that allows for a more amenable approach to their debt restructuring than just asking for more of the outright forgiveness that has been a bit of impediment with the Eurogroup creditors. So that is quite a change and has restored some hope, as we'll see when we talk about the early wild swing this morning. So what has all this meant to the markets? Well, it's very interesting this morning looking at the 60-minute S&P 500 future chart on the left, 30-minute on the right, that this market has currently been trading off about 12 points on the day after recovering all the way from the major low we'll discuss a bit later, back down to 2062 this morning, off of overrunning the 2058 to 62 resistance yesterday. But it has actually, earlier today, under the dual influence of the Greek situation still looking deadlocked and the Chinese situation looking dire, almost 1,000 companies now have suspended trading in their shares to prevent further weakness. Those of us who are a bit more experienced markets know that's silly because the weakness is there. It'll just hit when they reopen. So the bottom line is this market was trading down to a low of 2043 earlier today. That's right, folks, off $30 an overnight trade, but at least some potential light at the end of the tunnel that isn't a train barreling down the tracks ready to destroy the Eurozone has lifted it back up to the 2060 to 58 area once again. And as we look at the technicals, a lot of people ask, well, why do you concentrate on these congestion areas? 2060 to 58 has been an important over-under of late, in spite of the lows that were left here in the upper 2040s. We consistently pointed out the importance of the March trading lows in the 2040 to 37 range, and you can see why that is. Because as of right now, we have a situation where the new low yesterday, it looked terrible at the bottom of a $30 drop, was the first real test of the more significant underlying support. And once it held, and conditions seemed to mitigate a bit in Europe, then the market attracted buyers again to a significant degree, getting back up to close right up near 2074 after once again testing 2075 to 78. So what we've got is 2075 to 78 was a pre-existing level. So as the market opened on a gap lower going back to the beginning of the week 2 weeks ago, and it was below it, we sensed to get to 2060 to 58 or lower. When it rallied back last week Thursday up to 2075 to 78 early, but couldn't get through, it started weakening again. So we need to be aware of the pre-existing psychological levels to take advantage of the turns in the market. And that really sums up what is going on here right now. Watch those levels. Continue to watch them closely in this wide swinging agony, ecstasy, back to agony kind of market that we're in right now. That pretty much does it for the short-term view of the S&P 500.